Okay, good evening, guys. Before we start, as always, let's do the custom instant poll. Let's check everyone can hear the volume correctly. Put that on screens now. Let me know if the sound is perfect, too loud or too low. Standard setting, so it should be okay for everybody. Just vote as normal. Okay, majority of people are saying it's perfect. Thank you, guys. Okay, so trading psychology tonight. A very important, underrated subject when it comes to trading, to be honest. Again, it's always very difficult to kind of give you the benefit of my experience, but not just from being a trader, but mentoring some very, very big traders, and also a lot of newbie traders. There's certain things that come and happen time and time again that if you don't address them can really affect your trading in the long term. A lot of these really focus around the really small things of trading, the small things of how we act when we take a loss, the small things how we act when we take a winner. It's how people really take trading so very personally and think that every time they do something, is there a camera on my shoulder because somebody's watching me, because every time I do something I'm always wrong. It's just understanding why these things happen. First of all, when you press your button and your account goes red, you're trading on a spread betting platform, so you're always going to go offside the second you press the button. So all these little things, not to set off with a negative attitude, not to let yourself get too disheartened before the trade is finished. There's all these little techniques that I can bring to the table. And again, you're going to have to try and introduce them the best way you can. But the more we address these things, the better we're going to be. So before I start, as always, the risk warning that spread betting, safety trading both carry a high risk your capital, the possibility of losing more than the initial investments. These products might be suitable for all investors and intended for people over the age of 18. Please ensure you're fully aware of the risks involved and necessary to seek independent financial advice. Again, education only. Content of the webinars, personal opinion of the moderator at 9trade.com. Content does not constitute financial investment or tax advice. The advice to discuss are a specific requirement to an independent financial advisor prior to entering any bet. Intro.com is not responsible as claimed all any liability of the content of comments made during this session. Trading in probabilities. Okay then. So, that isn't the correct one. 1 second, guys. Trading psychology. There we go, that's better. So psychology, the basics. Well, it's the study of human behavior and the trait that every human expresses. So it doesn't matter who you are, it doesn't matter how experienced you are. Everybody, in somewhere down the line, is going to show some kind of human emotions. We've all heard of people like Sigmund Freud. And when we talk about trading, it's not really the psychology we're looking to explore. It's not that, you've got feelings, of whatever nature, to your mother and all them kind of things. It's more about your mental strength and how we can use our mental strength for trading success. Trading psychology is very different from the ideas of traditional psychology, and that's terminology. So we understand that what these guys taught, and obviously very groundbreaking at the time, very, very innovative and clever. But what we're looking at really now is how we use the psychology, in the terms of a trading state. So your trading state is how you turn up to your screen. So we're all, again, as we say, we're all human. So it doesn't matter if we've had a good day or a bad day. It doesn't matter if we've had a good night's sleep or a bad night's sleep. Anything external shouldn't really be affecting the decisions we make as a trader. Now, obviously, all these things are easier said than done. But the minute you start to think about them and start to explore this in a more rational way, the more you can approach it, the more you can kind of control the bad habits. So the key areas when addressing your trading state are the ones where it's most important. So for me, it's the trade entry. So what's your state prior to entering, to pressing the button to trade? That's when you're most vulnerable. That's when all the questions go through your mind. Shall I get in? Shall I get out? Shall I wait? Are these signals right? Am I getting the trade at the right time? This is where you're most vulnerable. And this is where you can end up turning good trades into bad trades. And you can also miss trades. How many times have you said, no matter what happens, I'm going to buy the bund at 625 or whatever the numbers are, and then you wait and you wait and you wait. It comes to that number, you don't press it. Then it goes 5 ticks on side or 10 ticks, in the direction you thought it was. Then you hesitate again. By the time you press it, you get in that small reversal, so you're offside, and then you think, oh no, I'm in too late, should I stay in the trade? And all these things that start to contradict your initial plan, your initial signals, are just made by that hesitation. So if you've got the right kind of trading state, the right kind of trading psychology and mythology about you. When you see that price, you don't hesitate it. You don't wait. You hit it and you trade. And that's all back to your trading plan. Okay? Again, if you're hesitating for any reason, it's probably for reasons that you're trading too big a size or you're trading after a series of losses. There shouldn't be any other reason to hesitate. Okay? If it's in your plan and you know what price to enter at, once the market gets to that, you just press the buttons. And if you can't do these things, work orders. Put sell limit orders, buy limit orders in. Anything that's going to help you to trade. That is, what you need to do. So again, it's all bases around all the things we've talked about, like why I have a trading plan, why I have an entry strategy, why I have an exit strategy. So when the markets are fast moving, you can, trick yourself out of trades. So then during the trade, now that's when the real kind of the technique comes into play. Can you sit and watch it? A lot of people don't like watching the trades go onside, offside, a little bit onside, then come back to you. Do you like to walk away? You've got your orders in to do whatever is necessary. Then the exit. How did you feel? Are you happy? Are you relieved? Are you sad? Are you emotional? Or you're not emotional at all? Again, interesting kind of things to consider when we talk about trading and making money and losing money. Then number 4, the analysis. Do you keep a journal? If you've got more the gambling mentality, do you only remember the winning trades? Are the losers? Well, there's a few, but generally I'm flat. Well, generally I'm flat, or I've just had a few losers. Isn't good enough when you talk about trading. It should be, I'm exactly this much up for my starting capital. I'm exactly this much down. Trading is not an approximate game. You need to know exactly how much you've made and you've lost and why you've done it. Because if you don't, you can't replicate success. So entering the trade. Again, all the key things that revolve around all my education. Are you prepared? Before you even press the button to put that trade on, ask yourself the following questions. Now, this again is where the psychological side comes in, and it's the thing called self-talk. You don't have to sit there rocking in your chair, like a mad person. You can ask yourself some sensible, practical questions in order to give yourself the right mental state and say, okay, have I done all the analysis I can? Am I prepared for my market? Do I know my fundamental analysis? Do I know my technical analysis? I'm in the right kind of frame of mind to interact with the market and understand where it can move today. Number 2, have I got my stop in place? Again, have you seen me trade live? I don't really ever trade with the stop. That's not because I don't think it's best practice. It's because I trade a small enough size for my account to be able to average in. So I'll average into a trade, and that's how I manage my stop. Okay, and it just builds up to a monetary level. If it gets too much, I get out. Okay, and I'll get out for losers all the time. Sometimes the fairly meaty ones. Sometimes they're a very small percentage of my account. But I don't mind if I don't feel it and I'm 40, 50, 60 quid offside. I'll just get out because I know from experience that I can let that 40, 50 quid escalate into 200, 300, 400 pounds. Okay, by averaging and staying in the trade when it's wrong. So sometimes you've got to press the button, just go, you know what, I'm out. Okay, red's red, a loss is a loss. It doesn't matter. I'll live to fight another day. I don't want to tie myself into a bad trade. I don't want to sit in front of the screen, trying to manipulate and massage a bad position. I'll just get out. Okay, but that takes a lot of time to understand how to do that. And also it takes a long time to understand that throwing away or conceding a small loss in the bigger term, in a bigger scale of things, is actually the right thing to do. So again, have you got your levels and your targets noted? The key levels that the markets hit every day, maybe every hour, every 4 hours. We should be aware of these. And then number 4, how is your state? How are you feeling? Are you apprehensive or are you confident? Sometimes you get up in the morning, you just can't wait to trade. You've got a good mental picture of what's going on, and all you want to do is get involved in the market. Other times you sat there looking at your charts and you think, I have no idea what's happening today. No idea. I don't understand what any of this is doing. Then all of a sudden you find yourself pressing the button, you're in a trade. Why? If you're saying to yourself you don't know what's going on, then why are you in that trade? If it's going up in a straight line, 40, 50 ticks, and there's no fundamentals out, or you see no technical breaks, then it's best just to stay out. You don't have to profit from every move that happens in the market. And again, as I keep stressing, these things come into your planning and preparation. Just because, the Nikkei might be moving 2 points in a straight line, doesn't mean everything else is going to follow it. Doesn't mean you have to trade that. Okay, less is more in trading. I found myself today, I've done some clever indicators. I've got my LA programmers, working on these clever little things for me. And I was short the New Zealand dollar versus the Australian dollar, and I was short Verizon shares, all because my clever system told me. Now, they came on side and I made a little bit of money, but I was trading the New Zealand dollar versus the Aussie dollar, and even on one tick or one lot spread, you're paying £9 on the spread. So obviously, I don't mind averaging into trades. So I was averaging in, and I just realised, by the time I got out for some profit, that was pretty much the amount I paid in spreads and costs were more than I'd made. So who's the real winner there? So again, it's not just because you can trade everything the right way to do it. You have to be structured, and you have to be prepared and understand that the cost benefit of what you're doing. So if you're trading something else with high spread costs, you go offside more initially because you're paying more than spread, and you're taking your attention away from other things that you trade. Again, I made probably 15 ticks out of that trade when other more noticeable markets are traded more often move 30 ticks. So your cost benefit, you're trading something that you're getting an edge because of a signal, but you're losing out on something else because you're taking your attention away, your focus away. So again, it's not always the grass is greener. Just because something's moving doesn't mean you have to trade it. Obviously, your entry point is a fine line between confidence and arrogance. Okay, when we talk about trading state and entering into a trade, you want to have confidence. Well, that comes from your preparation. It comes from being prepared, knowing what you're going to do, knowing the outcomes. It doesn't come from, I've won 10 trades in a row, I can't possibly lose this one, pressing the button. So again, self-talk. Ask yourself the following. Do you know what happened overnight in the US and Asian markets? Now, obviously, the European markets don't always follow suit, but the US is a good indicator, and obviously the Asian markets have spiked up or dropped 2 or 3 points. That's going to be some indication of what may happen in the next day's trading. That takes 2 minutes to check, so it's not a big investment in your time. So when we're trading now is a good level for support or resistance. Are you trading the trend, or are you trading a breakout? Again, all these different types of trade have different characteristics. If you're going with the trend, it's going to be a slow grind. If you're trading a breakout, you're going to be trading that initial breakout volatility and try and get initially onside and ride the trade. Is this the time to get in? What other indicators telling you? What's the volume telling you? Things like RSI I've told you to look at, the MACD, the demarcation indicator, all these different things are good to look at because they tell you if the market trend's likely to continue, or if we're going to reverse. Are you alert? Are you physically ready to trade this opportunity? Sometimes, your heart's not in it. You just can't physically G yourself up enough to be, to give the concentration, the markets, need you to have. So again, these things happen. Again, all you have to do is understand what physically you're feeling, and therefore what emotionally you're going to attach to your trading decisions. So again, after you ask yourself these questions, how many do you answer yes to? And really, for me, it's quite an easy indicator. If it's not 3 or more, then you're not really ready to trade. As I said, these are always guidelines. You're the trader. I can only tell you from experience, what these what these things mean and how they mean to different traders. So what you need to do is be able to replicate the feeling and copy it. So when you are trading well and you understand why you're feeling confident, copy it. And conversely, when you're feeling apprehensive and you press the button and or you get that gut feeling in your stomach that you're going to lose money, understand and replicate that as well. So when you press the button, it's on minimal size, or you don't press the button at all. But again, it's the easiest thing in the world to become a very unconfident trader. So you have to make sure you understand. And the only way I know how to do these things is put a scale of 10. 10 I'm feeling great, 1 I'm feeling not so great. And then by each trade, write that down. And if it's a winner, you'll understand what you were looking at. Technicals, X, Y, and Z. I was feeling a 10 and I made money. I was feeling a 7 and I made money. And then every time you're feeling a 1, 2, 3, etc., try and understand what you were looking at, how you were feeling, and that's got to cut some losing trades out your out of your trading week. And if you save 1 a week, 4 a month, 30 a year, that's going to add up to some money, isn't it? So all these little tiny things are the edge you need. And again, as I keep saying, guys, the planning and preparation, this is no different. If you don't plan and prepare around your trading psychology and your state, then you're missing a trick. Okay, you really are missing a trick. And again, I don't do it physically anymore. I don't write it down, but I know I've got a little routine of things I ask myself when I, open my spread betting account, and it's kind of like, how am I feeling today? Okay, right, okay. Well, we just say okay, bang, run small size. Then you start looking at your charts. Am I really feeling it? No, not really. Well, I'll sit and wait. I'll wait for an hour after the open. I'll wait for an hour after the open in the US. And if there's any data, maybe trade around that. But if you're feeling, when you open your spread betting account, well, yeah, I'm not really feeling it today, then the first thing you do is set yourself to small size. You don't start bang clicking on the plus size button, using all that margin and putting all that risk on if you're not feeling it. Simple little things, guys, but people forget to do them, don't ask themselves the simple questions, and end up losing money from it. Then you ask yourself, is it exciting or nerve-wracking? It should always be a little bit exciting. It should always be a little bit nerve-wracking. You're playing in the markets. You're trading with real money. It should never be terrifying. It should never be frightening. If it is, then take your money out of your account. Trading's not for you. Or you're trading too big a size that it means too much to you. There should be, no amount of money in your account you can't afford to walk away from. If there is, then, you're not going to be able to balance that risk-reward correctly. So real mental strength and trading state where it's going to be tested is running with a confidence theme. It is, again, remembering previous trades, how you felt, what you were thinking. So for me, there's two ways of looking at this in a practical way. You can put orders into the market and walk away. So you've decided you're going to go long or short, you've entered the market, you put your stop in place, and then you put your orders to get out. So that's your trade. Doesn't matter what happens. You know exactly how much you're going to lose. You know exactly how much you could potentially make. So it doesn't really matter what happens in the market. You could get out for 20 ticks, the market goes 100 ticks, but you've still made your money. Now for me, that's a good way of trading. That teaches you the discipline to walk away, and it teaches you the discipline to have a stop and an order to get out. Okay, some people don't like that because they want to see the market move. They want to see it happen. Let's face it, that's half the enjoyment with trading. We like to be right and we like to see our trades go on side. But for a kind of discipline and psychological edge, you need to be able to do both things. You need to be able to put your orders in and go, well, that's my decision. That's the choice I've made. That's the money I've paid. And now I'm getting in the market at this point. I'll get out this for a loss. I'll get out here for a profit. So the other mirror image of that is to sit in front of it and be like the trigger finger, sit and watch. So you put your trade on. You know exactly where you want to get out. You know exactly where you want to stop. But you do it all on your own. You do it all manually. Now, obviously, inherent risk with this, that you might have to leave your trading station for some reason. There might be something you called away, you don't have full attention, but that's a choice you take. For me, I like to have a balance of the two. So I'm happy to kind of put a stop in if I walk away. I'm happy just to, again, generally trade enough size I'm comfortable to leave it no matter what. Again, this comes from experience, comes with your trading style. I'm generally trading towards the top of the ranges, so it takes something fairly extreme for my trade to go way against me. And if it does, again, it's either some data I've not been aware of, or something that's come out in the market, or I'm just wrong. And that can happen. So you make a decision to maybe average some more and manage your trade, or you just get out for a loss. So you should fit into one of these categories. Again, you should either work trades with the market, or again, just be interacting with the market as and when. So this is the same for everybody else in the market. You're trading as other people, remember. So they'll have their own psychological, rules and their own trading plans in place. But remember, the markets are huge. You've got long-term traders, short-term traders, swing traders, scalpers, bank traders, hedge funds. So the markets can move for all different matters. So what you have to understand when we're talking about the market sentiment is that that's what it is. The market is building up its opinions through collective consciousness. So how you fit into that is how everyone else fits into it. So you might be very, very sensitive, to an hourly candle because you're waiting for that break. And somebody else, who's got 1,000 lots on could be waiting to get out of a position. So you just don't know what the market sentiment is and what it's trying to achieve. People can get caught long, they can get caught short. It depends, again, as I've always said, what style of trader you are. You're either a short-term intraday trader who doesn't hold overnight positions, or you're a longer-term position trader who holds overnight and looks for the bigger moves. We're not really scalpers anymore. Even, as someone that looks to steal 5-10 ticks out of the market. If you're trading on a spread betting account, you can't trade at a scalp. You can't trade a tick because you can't lean on the bid of the offer. So you have to be within your realms of understanding how that works. You know, you're not a market maker. I could scalp ticks by being the bid and the offer when I was a market maker, but I can't do that now. I press the button and I've paid my cost, my price to get in the market. So you're already offside. So you have to make that money up. So you can't really be a scalper as in, you know, tick per tick. You have to be a scalper as in looking for that short-term blip, momentum, push through. Okay? Look for any pain in the market. You'll often hear the term stop hunters, stop grabbers, and that's these long pin bars where they move the markets in aggressive directions and then hit the tops of the markets. People get out of the positions and the market comes back, overextends is exactly what you think. So look for these to happen in the market. Certain markets can accommodate this, certain markets can't. Then again, always look for your fundamentals. These can affect your trading decision, of course. So clear thinking is positive trading. Now, trading in the zone. Now, I had to put this in because it's kind of accepted. When I write my book and I finally finish it, there'll be nothing about trading in the zone because I've traded for a long time. And trading in the zone, okay, it's you might have heard of it, and what it seems to be is that trading's transparent. You become like Neo in the Matrix. Nothing you do is ever wrong. Okay, now that can happen to a tiny extent, but it's never as you think. It just means that you take very little pain on your trades. So all it means really, in effect, is your entry point is correct. Your entry point's good, so you take very little offside position and your trade goes onside. Okay, so that's all really trading in the zone is, just picking the right entry points. Then you don't have to take all the mental stress of the markets going offside and going against you. So again, it's all about replicating when you do feel good, and maintaining that emotional stability, maintaining that confident mindset. You're only really focusing on what you're doing, what you're trading. Once you do that and do them three things, then you're really in the zone anyway, because you're not fighting with yourself, you're not arguing with the technicals, you're not saying common statements like, I don't understand why the market's doing this. It has to come back, okay? Why is it doing this? Then when you start attaching that emotional connection with the trade, and you're trying to short the market, it does nothing but push up, and you say to yourself, why are you doing this? Why? That isn't doing this, or this isn't doing that. Why are you doing that? And it continues to go up, and you get out. The second you get out, the market comes back and then goes onside where you would have been. These things, just happen in trading, and they generally happen when we're wrong. So the emotional stability, the mindset, the focus has to be on what we can control. Now, really, for me, is getting out. Getting out when we're wrong and just walking away and saying, all right, okay, I've gone offside more than I want to in this trade, so I'm going to get out. Because if I'm getting out, I know other people will be getting out too. That means the market's going to doubly overextend. And then when it does go up 10 ticks, another 20 ticks, then I'll sell. Okay, but I'm not going to hold on to this trade and let it go any further offside. I'm not going to take it personally. I'm just going to get out this trade, take my loss where I said my stop was going to be, and then let the market go up as far as it wants, pick a point, and then sell it again. And that's what you have to do. So when you exit for a loss, now exit for a loss is for one or two reasons. Okay, so profit or a loss. Now all traders sometimes have to take a loss. Doesn't matter who you are. Warren Buffett has had to take a loss. George Soros had to take a loss. I've certainly taken a number of losses. But it's the manner in what you take it. How you take that loss. That will ultimately define you as a trader. So have you ever said the market's wrong, you shouldn't be doing this, I don't understand, or why is it not going, why is it not moving? It's being squeezed, being pushed, and it will come back, or it has to retrace at some point. So if you've said that, you've generally, at some point, when you've said any of them one things, get out for a loss. Now, you don't have to agree with me, you don't have to say yes or no. I know because I wrote this, I know because I've done that, I've said all them words personally, and I've heard them probably 1,000 times. So this happens to everybody, okay? But you have to say to yourself, when you're doing these things, you need to be pressing that button for one reason and one reason only, to be getting out of trades, okay? Because you're going to cut your losses that way. So for me, if you stick to your risk reward, a losing trade can really be a winner. Okay, that's the only way I can take a positive out of that. The only way I take a positive out of any losing trade is that I paid for that information. I paid the market for the information that at that particular time I was wrong. So of all the years, all the ways I've looked at it, that's the only way I can justify or feel any kind of pleasure in trading when you've taken a loss. No, it's an oxymoron, but yeah, that I paid for that information. I've actually got something out of the market. I've paid for information to tell me I was wrong. So again, try it yourself. See what's going to work for you. There's nothing wrong with the scratch, but again, what were you thinking? It's one of my kind of pet hates really in trading is people that scratch a lot of trades. Nothing wrong with scratching trades. Nothing wrong with being very, very cautious. But if you put a trade on, you put it on for a reason. Why are you getting out of that trade? And certainly, why are you getting out of your entry point? Doesn't make a lot of sense to me. You have to let the market move in a direction, almost breathe in a way. So what's the point of getting out of a trade? What you got into? What changed within the market? What was not said? Do you not have a clear exit? Do you not have a clear stop in place? Was it new fundamental news? What made you get out of that trade? Because generally, when you come back to a scratch, you've gone offside. So you've taken pain, okay, offside, and then you come back to your entry point, and then the trade's got to have time to go. But again, if you get out of the trade for a scratch, you're not giving it that time to move, are you? So for me, scratching, it's kind of a pet hate. It's not a good habit to get into. It's not something you should do a lot of. So getting out for a winner. Well, obviously this is why we all trade the markets, isn't it? To get out for a winning trade and make that profit. And you can learn a lot from winning trades, but again, only if you're prepared. Again, write down this trading state. Write down how you were feeling. What the factors were, how you were prepared. All these different lessons, you've learned by making money out of the market. How can you then replicate it? Okay. And again, it's not just that trading state, but it's that discipline, the rules you followed. All these little tiny things, however minuscule, add up. And the more you understand them, the more you put them into your plan more often, the more money you're going to make from it. Okay, it's simple as that, isn't it? We've all done these things. We've all traded enough times to understand when it's felt right, when it's felt wrong. Okay, and it's just being aware of that. And that's really all the psychological side of it is, just being physically aware. It's like, okay, I know I'm feeling like this. I know I'm, again, go like anything we do, sometimes, let's pick a good analogy. Can't think of one offhand. It's like driving. Sometimes you go around a corner and you think, that was a little bit too fast. Luckily, nothing was coming the other way, or luckily the road conditions were good. And you think, yeah, but it's like that, on a different scale. It's like, yeah, this does feel right. I'm not really panicking too much because I know this indicator's saying this. I know everything else is pointing to that, so I'm feeling all right. And then other times, you put a trade on, you're thinking, well, that indicator's not really telling me anything, and that's really moving away. It's kind of, it's feeling, it's a bit of a punt, this. And that's when you've got to really kind of understand their feelings, and then again, as I said, replicate them when they're good feelings, and then cut them out when they're bad feelings. As I said, it's all analysis. We love to analyze the markets. We love to look at charts. We love to look at past data. But why are we not so keen to do it on ourselves? We're the biggest, most powerful tool we have, our brain. So why don't we analyze how we're feeling, what we were thinking, what we were doing? Why don't we do that? Again, if we don't do these kind of things, then we're really missing out of a trick. We can analyze everything else, our money, our charts, our oscillators, anything to do with trading. But if we don't analyze our own self, our own brain, then for me, we're really missing a big trick there. It's all about the 3 M's, really. It's trying to balance the money, the method, and the mindset. All 3 of these things are important. It's like, it's like the rules in life, the 3, having the 3 pulleys, that you can only ever have 2 equal at one time, and then one has to get shorter. So you can have the money, and you can have the freedom that comes with it. But then to get them 2 things, the time element shrinks down. So you've got a small handle of time. You pull the time, you've got a bit more freedom. Then the money goes down. That's the smallest lever. So you can only have any two. Your hand on 2 things at one time. One has to give. So you either have to have all mindset, all the method, and the money goes down. Okay, because you're not really focusing on the money. It's more what's happening. You're too preoccupied. Or you can have the money and the method and your mindset. So it's all like trying to keep these things as balanced as you can. If you fail to plan, you're planning to fail type thing. Trying to keep everything in proportion. Your trading plan? Well, you've all done the Trade for Life course, hopefully. You all should have a trading plan. And do you use it? Well, like I said, it's up to you. The trading plan's one side, the trading log's another. Okay, what you have to understand is which ones you want to use. You want to use any at all. But again, you know my opinion on these things. If you don't use them, then you're never going to learn from them. So the rule to get a trading plan, well, number 1 is ask me. Number 2, there are no rules. Okay, your trading plan is as unique as you are. Record what you feel is useful. Remember, less can be more. Don't record everything. Don't just sit there and do war and peace. It's not for that. You have to understand that your time of trade, your entry, your exit level, and how you are feeling. Make it all relevant to you and something you can go back and say, well, I was at this level in the euro dollar. I was feeling good, but every time I did that, I lost money. Then you got somewhere to start, something to gain from. There's absolutely no point of continually just doing the wrong thing over and over again. So here's an example of a trading log. You can just Google trading log. You can have something on as fancy as this on a spreadsheet, or you can just use the simple PDF that I give out. And something written for me is just as powerful as anything on a spreadsheet. So the conclusion is, as we know, trading confidence comes from preparation, doing the right thing over and over again. If you don't know what you've traded, how you've reacted, how you're ever going to learn from this. And only you decide when you trade. Only you have the power to push the button and trade. So you don't have anybody else to blame for this. You have nobody else to analyze for this. So for me, all these things, again, you have to understand what is relevant to you and replicate what's relevant to you. You can't copy trading success. You can't just keep copying other people. All right, guys, any thoughts, any questions on the trading psychology? Okay, John's just saying a good one. He finds taking a screenshot of entry and exit, it was really useful to review at the end of the day. Absolutely, John. That's a really, really good point, actually. Yeah, thanks for that. Laurie's just saying extremely relevant point, and also thanks for John's help last week. Both of you trades a winner for a change. Well, that's what it's all about, guys. Listen, it's all about learning from each other, getting these communities together, and everyone helping each other out. That's it's the collective kind of consciousness and experience. We all learn things in different ways, and again, I try and make it as interesting and as relevant as possible, but everyone will have their own spin on everything that happens. So that's great, John. Cheers for that, and thanks a lot, Laurie. Okay, guys, any other questions, any other thoughts on trading psychology? Again, remember, these things take a long time. You're not just going to wake up one day and it's all going to fall into place. It takes a long time to understand yourself and understand how comfortable you are in the markets. Okay, guys, well, there's nothing else. We've got non-farm payrolls, funnily enough, tomorrow. The revised non-farm payrolls will be coming in tomorrow, so join me 1 o'clock for that. Again, due for the US shutdown, it's been a bit of a reshuffle. So this month's non-farm payroll will be tomorrow, so join me for that. It might be a nice little Brucey bonus. Again, the markets seem to have discounted all this shutdown business and are making higher highs. The markets seem to be storming ahead, so will this make any difference? Will it make a difference? All right, guys. Well, anything else at Steve Ruffley is, how to find me on Twitter. SteveIntro.com is how to get hold of me. I'm not a difficult one to find, guys. So anything you want to, just let me know. All right, guys. Have a great evening. I'll speak to you all very soon. Okay, thank you.